Welcome, Real Estate Hustlers Podcast. I'm your host, Josh Appleman. Today, we're joined with John Makarewicz, managing partner at Faris Capital Partners. Blends 2 decades of leadership and real estate expertise with a passion for excellence, discipline, and lasting client success. John, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, so great to be here, Josh. You kind of nailed it. Just been in real estate pretty much all of my career. First in residential, and with my business partner at the time, we grew and scaled that business up, had a successful exit, and through that business, just formed a relationship with my current business partner. And when the time was ready for me to move on to that next opportunity, it was right at the same time he was contemplating starting our newest venture, Faris Capital Partners. So, big on family, big into music, and just business, man. I just love growing and building businesses. That's my passion. So, excited to be here today.
Let's take it all the way back. What did you do before real estate, and then what got you into real estate?
So what got me into real estate was necessity. I got married at a young age, and I was still working through my way through college, and we actually had a baby on the way. And so the motivation was simply, what can I do to make some money until I figure out what I really want to do? And I genuinely got into residential real estate with that mindset. It was like, well, I'll finish college, and then I'll figure out what that next thing looks like. But I ended up really loving sales, and I found out very quickly that, if you focused on service and you just were exceptional kind of in your communication, you really could do well. And of course, residential real estate doesn't always have the best reputation, right? So coming at it from that viewpoint of I'm going to be better than every other agent, and, had a successful first few years in the business, and then the Great Recession hit. And around that time, I was looking around, my income had gotten cut in half just based on the market. And met my, who became my business partner, Mark Spain. He was just running a real estate team, and he was looking for a couple agents to help support his business. Like, he was doing more than he could handle. And when I joined, there was 9 people. And when we had that private equity exit, we had scaled it up to 650 people with locations across the United States. So it was like sprinting a marathon for 15 years. So yeah, it was really by accident, frankly, that I got into it. But it goes back to, I like finding a business like, say, for example, residential real estate that is almost in a sense commoditized. I mean, there's like 1 million plus real estate agents in the United States, only 6 or 7 million transactions in a decent market. This year, we're looking more like 4 million transactions. So the average agent is doing 2 and 3, 4 and 5 transactions a year. And, that ability to come in and through service and experience, create something that feels a little bit different and differentiate myself, and then eventually the business we created in that way. And, it led to private equity attention. So, it's amazing to me how service in and of itself can be a differentiating factor in certain industries, particularly real estate.
So you all built the brokerage up to then exit with PE?
Yeah, that's right. Yeah. So our model was very unique. Now, we are not the only ones to do this. And there are a lot of agents, as they grow their business and maybe say, for example, they're tapped out. They can't take on any more clients. So an enterprising agent may hire an assistant or eventually bring on a listing partner, to take on some of those leads they're generating. So we sort of did that on steroids. It started out that way, but eventually we started doing some mass media marketing. We were formed originally in Atlanta. So started with billboards, then eventually radio and television. And what made us a little bit unique and allowed for this scaling to occur is in the Great Recession, all the single family rental entities started forming. So Invitation Homes, backed by Blackstone, America Homes for Rent, which was the guy who started Public Storage. There were many others, Colony Homes. And so that was around 2010, 11. And because of our billboard presence and sort of like we were out there in the marketplace, some of those groups started knocking on our door asking, could we help them acquire homes for their portfolio? And so we were trying to figure out how can we stand out and, instead of just saying, hey, we're the best, we have great service, right? What's our marketing hook? And so what we figured out pretty quickly is we have a buyer over here that's pretty much anxious to buy anything and everything they can get their hands on. I mean, we sold tens of thousands of homes to Invitation Homes over a few years. And on the other side, we have sellers in a very challenging market that are, nervous about the ability to sell their home, right, during the Great Recession. So what would happen is we would bring cash offers from the SFR groups to the listing appointment and say, here's an option, or here's your on-market option. Which do you think works best for you, right? I'm simplifying it, but that was the pitch. And so that allowed us to scale up very quickly, not only because we were closing all these deals, working with these SFR buyers, but we were also making quick sales for a lot of our sellers in a very challenging market. So that became the guaranteed offer, which we still market to this day. I actually have equity in that business still, even though I'm no longer working there day to day. And so in a sense, we were almost in a way doing what the iBuyers like Opendoor and OfferPad eventually sort of created with their sort of SoftBank money and tech-based platform, except we weren't taking the balance sheet risk of actually acquiring the property. We were just sort of a marketplace between these SFR funds and the sellers, the homeowners, right?
So yeah, you were assigning the contract.
But pretty much. So how it would work is they would give us, Invitation Homes in particular, they were one of the bigger groups we worked with. And then over the years, to this day, there's like 12 different groups that we still source for. But they gave us underwriting authority. So we knew their metrics. We had their model. We could write offers on their behalf. So basically bringing an offer like ready for that seller's signature. And, about 60% in the Great Recession were taking them, 40% worth. And depending on the market, that would kind of flip flop. But it was really the hook that got the leads to come through the front door. And then our sales team would convert those leads into appointments for our agents. So private equity looked at that as this is something unique and different in the marketplace. Like traditional brokerages are really more about the agent, right? Their economic model is based on headcount. How many agents can I bring in paying a monthly desk fee, take a percentage of their commissions, and, different brokerages have different approaches to that. But the premise was all about serving the agent, where our model was really about serving the client, because our agents weren't sitting there worried about where their next piece of business was coming from. An average real estate agent, as you probably know, might spend 60% of their day prospecting for business. Our agents spend 100% of their day servicing their clients. And so because of that model where we're providing the appointments, the company retained a larger percentage of the commission. So our profit margins were like 4 or 5x the traditional brokerage. So once again, it kind of looked at private equity, goes, okay, this is something a little bit unique and different in the space. And, it had that growth model. We were able to stamp out multiple locations across the Southeast and find that consistent success. And then, that's when we sold. So it was a fun journey. I'll say that. It's funny in hindsight. I think back, the more challenging times are the ones I remember most fondly. Right, that first time the Great Recession hit, and like, what are we going to do, and how are we going to approach this situation? So a lot of lessons learned along the way there. So excited to apply these lessons to my newest opportunity.
Yeah, no, that's the whole pivoting, being able to pivot, being able to re-identify where your business is going and make it successful. And then before you know it, you got something bigger and better. It sounds like it's exactly what you did. You niched in. Very cool. I know Zillow got into iBuying. I don't know if they still are. I think they got in and got out, and then racked up a huge balance sheet and did a fire sale, I believe.
You're dead on. Yeah, that was interesting because Spencer Raskoff, who was the CEO at the time, actually had spoken out against that idea. And I can't remember the other guy's name, but he was one of the co-founders. And so they actually bumped Spencer out and brought the original CEO and one of the co-founders back in. And they went all in on iBuying, but it was about a 9-month experiment before they wrapped up and took their toys and went back home. It's a tough business. Look, Opendoor right now is sort of effectively a meme stock. Like, I don't know if you've been following that trajectory, but gosh, like 3 months ago, it was like 75 cents a share. And I haven't looked recently, but it got all the way up to $8. And from the start, and what was interesting is actually we were doing and still do a ton of business with Opendoor at Mark Spain Real Estate. What they failed to realize is that they were looking to replace the agent. And I think what they're slowly, and they have been working on this for years, but now they're really coming to grips with, is that they should just be an add-on to the agent. And so, at the end of the day, the majority of people still transact with a real estate agent. So despite many efforts from a lot of money, billions pouring into the industry to disrupt the real estate agent, it just hasn't happened yet. So they started realizing that, look, we need to partner with agents and have them be a distribution channel for our product. And it's changed quite a bit from when they originally launched, but they're still out there. But yeah, Zillow, they closed up shop pretty quickly on that program, and rightly so. Now they're back and they're super profitable. Their marketplace is fantastic. In fact, they're getting into the multifamily business now, trying to go after apartments.com. So yeah, I think that's a great example of businesses should really have like 1 or 2 core things they do. You shouldn't go try to do 17 different things, right? And I think that iBuyer thing was a bit of a distraction for them. And, frankly, probably upset a lot of agents that were marketing and advertising on Zillow. So they pulled back their spend. So I think it's right for them to step out of that space and just focus on their core competency, which is the marketplace they've created.
But they were buying them, fixing them up, and then reselling them, or I can't remember if they were keeping them or not, but they had the entire operation.
That's right.
Full vertical integration to where you're managing the contractors, the material, the operations on the ground, and that is the heaviest part, is the operations once you actually acquire the property.
That's right. I mean, and these iBuyers, they're publicly traded companies, so you can go read their financials. I mean, their stated goal was to make 1% per acquisition and flip, right? So with margins that thin, if you get one thing wrong in the underwriting, you're dead, right? And so what happened is, around that time, we were sort of coming out of the Great Recession. We were in a bit of an overheated market, and there were times where, based on our analysis of what a home might be worth, Opendoor and Zillow, and maybe to a lesser extent OfferPad, were in some cases offering like 103, 104% of market value, right? So you'd kind of be stupid as a seller not to take that offer. And so, look at Opendoor. When the interest rates tripled in 2022, they had to write down $1 billion, right? Now, I will give Opendoor credit. What they didn't do is cancel all those contracts. They took their medicine, and from a reputational standpoint, imagine if they took $1 billion in transactions and just in one fell swoop canceled all those contracts. So, right or wrong, they made that decision. But they're still bumping along. I don't have much view into Opendoor these days. I kind of now in this multifamily world, so I don't focus too heavily on the residential side anymore, but they're still out there refining their products. So it'll be interesting to see what it looks like in 5 years, I suppose. But that iBuyer program, brilliant idea in a sense, but just I don't think the execution was really possible the way they wanted to do it. Now, what I understand Opendoor is doing today is they're doing sort of a hybrid model, in a sense, where they buy your home and you pay a fee to them, very in line with, say, a typical commission of, say, 6%. I don't know the exact economics. From what I understand, they charge 6%. And then what they do is, when they go to resell the home, if they sell the home for more than they anticipated, their goal is to make, I think, 4% now per acquisition. They'll actually rebate some of that additional proceeds back to the original seller. So they remove some of the risk from the seller, but they're not paying market value anymore. They are taking a bit of a discount on the front end. So it's kind of more of a variation of that program. So we'll see. It'll be interesting to watch over the next few years. That's for sure.
Yeah. Very cool. So you had an exit with PE, and that was a liquidity event for you, and then that propelled you into the next venture. And did you have to start from scratch learning about multifamily, educating yourself, or did you learn how the underwriting and everything just kind of went as you were in the other venture?
Well, it was all kind of learning as we went. Now, what happened is I had actually, I had like 9 months, when I left the company, the way it was structured, of severance and health benefits. So I'm like, I can just kind of chill for a little bit and just reset and recharge and figure out what I want to do next. And my current business partner, Mark Faris, who we started Faris Capital Partners with, we had been friends for years. And within a week or two of leaving, we had a scheduled call that we just had on a monthly basis. So I shared with him what was going on. And before you know it, he's sharing with me his idea for Faris Capital. So, I told him, look, this has all happened pretty fast. Like, I haven't even put my feelers out into the world to see what else is out there. But I really liked him, and I understood his ethics, as somebody who we masterminded together. I really understood his thought process around running a business. So that felt very natural. So it was about a 2-month process where I read a bunch of books on, multifamily investing. Prime example would be Joe Fairless's book, the Best Ever Real Estate Syndication book. Mark and I attended actually Joe Fairless's conference as well around that time period, and just spent hours on the phone together just talking. And so his view was, look, like, how to operate a business, how to build out the systems and the infrastructure, build out the team. I have all this experience investing. So what we did was, because we had these, successful businesses in the past, we were able to fund the business in such a way where we didn't just, start with the two of us, right? We went out and we hired an asset manager with 20 plus years experience. We went out and hired an acquisitions person with 15 years experience, who closed over 1.2 billion in multifamily transactions in his career, and then marketing and all these other things came along the way. but we went out and surrounded ourselves with people who are smarter than us in the business, right? In the actual literal industry of buying and acquiring value add real estate. So that was how we did it. And then, I took some classes online on underwriting. I got a team member. I mean, Joe, our acquisitions guy, does the underwriting, but I know enough about it so I can ask the right questions. But yeah, it was really, we built a team around us that had the experience to make sure we didn't, stub our toes or make any big mistakes along the way, being a newer company.
Got it. So you formed the company, or the company was already formed. You joined, and then you hired the expertise around you. And then did you start going after deals? Did you have a deal in mind to begin with?
Yeah, no, we started the business and then we started hunting. So
Okay.
it was kind of backing up right before I started, just to ensure we could raise the capital. My business partner, Mark, found a couple operators, did a lot of research, found a few groups that he liked, and came in as a co-general partner. So bringing some of his expertise into the deal and also bringing some capital. So he was able to successfully raise 11 million in capital across these two deals. So that was okay. That was the question. Can we raise capital? We answered that question. So that's around the time where he got serious. We're doing this. And that's when him and I started having these conversations. So, the first step, when we literally day one, when I started, we were in a conference room in a hotel and we sat down and we, wrote out our mission, vision, and values. We wanted to establish some, what we call golden rules. What are the things we won't do? What are the things we will always do? And then looked at, the markets we wanted to potentially consider buying in. And, from that standpoint, we started reaching out to brokers. One little trick that worked well for us, and because once again, we had the capital, we infused the business with some capital to get started. We actually would send welcome gifts to the brokers in the markets we were targeting. So, a nice box with a couple Yetis, and just our buy box and a flyer, a little bit about us. And what that led to is, when that happens, right, it's like they almost have to give us a call just to say thank you or shoot us an email, right? And so then that opened up the conversation. And then we had initially focused primarily in Florida. A lot of our investors are in Canada. And so our thesis at the time was Canadians love Florida. They vacation in Florida. They know Florida. So that's just going to be easier for them to digest in terms of an investment opportunity. So that was where the focus was. So we went down to Tampa and we just reached out to brokers and either had a coffee meeting or went by their office, introduced ourselves. It was interesting. Some of the conversations, I mean, they were rough on us, right? They're like, you guys are going to get your butts kicked, basically, was the feedback. But, we're very aggressive guys and we hate to lose. And so we put an offer out. So we started April 23. We put our first LOI out in September, locked that one down in October. It was an assumption deal with Fannie Mae. We closed that one in March of 24. And immediately behind that closed two in Charleston in May. And then this year we've closed one in January, one last month, and we have another one closing next month. So starting to get the momentum going.
Yeah, no, where's the capital? Is it from family offices, retail investors?
Retail investors exclusively at this point. We have some irons in the fire with some larger check writer groups, a couple family offices, but because we're new, the feedback we keep getting is, build up that exit track record, which is understandable, right? The family offices, if they're going to recommend their investors come in, right, like they want to see that proven track record. So our average check size is $140,000. So we just, chip away at that. Our most recent deal was a $12 million raise. So, it's just $140,000 at a time is basically how it worked. Now, we've also learned, to build out some additional share classes. So the larger the check you write, we actually peel a little bit off the promote, make the unit economics better for those larger check writers. So that's been great. We also created a Class A structure that's, kind of like almost like a pref fund. It's not treated as pref equity, right? But sits right above. So we usually bring $1 million or $2 million into that, at a 12% cash on cash return. Initially, it was not popular, but on the second and third opportunity, as people digest it and learn more about it, we've now filled those share classes up pretty quickly. So right now it's all retail.
So are you all giving pref or is it pref accruing?
Well, and I say that it's more that it's in a sense treated. So we pay a 12% current on it. There's no accrual, but it's just for those investors that want to reduce their risk a little bit. Of course, it sits just above the lender. The other LPs are below. So we once again only allocate a small amount into that. but we only buy deals that cash flow on day one. So if the deal can support it, we've just found it's a helpful way to meet that investor that's maybe a little more conservative. And I'll share this because in Canada, a lot of high net worth individuals actually invest in private debt. So their mortgage market is vastly different than it is in the United States. And so a lot of high net worth investors put their money into mortgages. And so we were trying to create something that would feel very similar to that, steady, stable monthly cash flow. And so that was really the premise. So when I say pref, more so just in terms of how it sits on the capital stack, there's no special rights that these investors have. It's just they'll be first in line to get paid. And by doing that, of course, you do juice the returns for the other LPs. But on our side, we have to be very confident in our ability to hit those pro forma projections, right? Otherwise, our LPs could be, potentially exposed to some risk there. So it's something we didn't jump into quickly. We made a lot of thought into it and make sure the deal can support it before we offer that. But that's helped for those either A, more conservative investors, or B, those that are used to the private debt market in Canada and just like something that feels similar.
Got it. That makes sense. It's a coupon flipper. It gets them in and makes them feel secure. So you bought your first deal in 2023, correct?
24. We put it under contract at the end of 23, but it was an assumption. Our first two were both assumptions actually with Fannie Mae. So it was that typical 4 to 6 month process to navigate through that. So the closings were pushed out a little bit, but first one closed May of 24.
Yeah, my experience, no matter how hard we've pushed, we've reached our pro forma rents a little bit under 24 months, no matter what.
Yeah.
It's because we do value add as well. So you're renovating, you get your first leases. They still have to deal with the nonsense from the old tenants that are still there in the mix of things. But you really reach your pro forma on the second lease.
Yeah.
Whether the first lease stays for the renewal or you're just leasing up because now the community's much better, much nicer, and now you can reach what your performers are. What has been your experience with that deal?
It's been fantastic. So one of the things we actually sort of thought about before we acquired our first deal was, what does that resident go through when the property sells, right? And trying to put ourselves into their shoes and recognizing that in a lot of cases, it's like the ownership changes, but nothing really happens, right? Except maybe the rent goes up. And so we thought about how can we add value immediately, right? In such a way that they oh, wow, new ownership, because when those, notices go out, the residents all start talking, right? And what's going to happen? Are they going to raise our rents? What's going on? And so what we did on our first deal, and we do on every subsequent deal, is on day one, so this deal we're closing on the 15th of October. Like on the 15th, we'll be on site. And the second it's closed, right, we start tree trimming, we start pressure washing, we rebrand as quickly as possible, first with temporary signage and then, full on redo of the monument signage, all signage around the building. We paint, we put in all new lighting on the exterior, we enhance the amenities with the goal of doing all of that within the first 30 to 45 days. And so then at the end of that 45 days, once it's all done, and maybe we built out the dog park and the grilling stations and all that stuff, we do a resident welcome event where we bring out a food truck and Kona Ice and the whole team comes down. And so it's not just like we're sending our property management team, like Mark and myself go. When we meet residents, we shake their hands, we get to know them, we ask what they like and what they don't like about the property, and just try to get that feedback. So what we try to do is immediately show that, yes, there is going to be some changes here. And, if people ask, your rents may go up, but here's what we're going to do in terms of that value added. And we show it as quickly as possible. And so that deal, as we sit right now, we are about 14% of our NOI projections. So to your point, you have to clean up the rent roll a little bit, and sometimes have to deal with some bad decision making the previous owner did in terms of who they let in or whatever. I mean, more often than not, what we find is the ownership is sort of not necessarily paying that close of attention, and the property management is the one drifting with their standards, right? So going through that process, and then in that first 30 days, we renovate a model unit. Right, set that up, and that's part of that welcome event. We take everybody through a tour, and so that often results in people saying, I want a renovated unit, and so they'll move internally, which then opens up, another unit we can renovate. Right, so that's just something we've learned, that the quicker we can show the value and really demonstrate the value through meaningful change, then we've won over their hearts, right? And so at the end of the day, they're more apt to accept those rental increases that may come, as we move down the path.
Yeah. Yep. No, that's dead on. Very cool. The title of the episode is 3 Mistakes Operators Make. So give us Let's hit on that. What would be the three mistakes that you've seen on your standpoint of what's avoidable, but you've seen that could impact the property, the project, the business plan?
Yeah, so I would say what I just mentioned is the first mistake. In other words, they wait to deploy their capital, right? And they don't add that value immediately. I think it's very important on as soon as possible to set a good impression with the current residents. Whether that is, if there's major heavy lift going on exteriorly, but do that as quickly as possible. I think that sets the standard and it sets the stage. It shows them there's like quote unquote a new sheriff in town. This thing is going to be operated differently. And that, yes, rents are going up, but they are getting something in return. For example, at that Largo property, we added a gym, we added grilling stations and game stations, we enhanced the dog park, and we took the pool and reimagined it with all new furnishings, and just made that impact on day one. So I think that's something I've seen where I've literally been on property where the ownership group has had it for 2 years and they're still waiting to redo the pool area, right? Yeah. It's like, get that done quick, man. Like, you've got the capital, deploy it, get it out there and allow it to start working for you, right? And allowing you to attract a higher quality resident or a resident willing to pay more in rent. So that's definitely number one. I see that a lot. Number two, I would say, is they're too trusting if they're leveraging third-party property management. And what I mean by that is, I literally try to go to every one of our properties at least on a quarterly basis. Now, the benefit is that we're only buying in a few key markets. So if I'm touring a deal, then I'm coming by the properties that are in that market, right? So often looks a little bit closer to monthly. Our asset manager is on site monthly. And
hopefully unannounced.
Yeah, well, that's right. And that's what I was just about to say, right? So when I'm doing a property tour, I don't make a big announcement, right? I just pop in. And, there was an example on one of our first acquisitions in Charleston where I pulled up on the property and I literally collected half of a bag worth of trash just walking around before I even walked through the front door. So I walked in with this bag of trash. I was like, guys, like, what is going on here? There's 3 of you here. Like, how did this even happen, right? And good feedback moment. And ultimately, that was the first red flag that led to us changing the property manager, because she walked past that stuff every single day and didn't do anything about it, right?
Yep.
And so I think that, being on site, checking in, and when you're on site, talking to residents, like, don't be shy. If you see somebody walking to their car, greet them, ask how they like living there, right? So that on the ground intel is so important. And to your point, those unannounced visits, if they know you're coming, it's going to be the best possible presentation, right? They're going to have everything clean, everything's going to be tight. So just those random pop-ins are huge. But going back to the property managers, I mean, we have weekly meetings at the level with the property managers and the leasing managers. We do huddles 3 days a week with all across our assets. So it's all 5 today, 6 next week. So they're telling us what their priority is for the week, what their number one metric is, and what's the most important thing that has to happen, and some good news and an update previously. So the other, properties benefit from, lessons learned at, the other property, right? It's like, hey, we tried this thing and it worked really well. So we try to create interconnectivity between all of our assets. So they're not just on an island somewhere. So they start now calling each other and asking for advice. So creating a community amongst all of our third-party property management. All of our stuff is with the same company. So they've been really helpful in allowing us to build the structure out in the way we want it done. And then, of course, we have weekly check-ins with the leadership team, our regional, and monthly deep dive financials. So it is very, very highly accountable process that we run with those property managers. And part of it too is like they share our values. So it's not like some arduous process. It's just like we found the right group that recognized and appreciated our approach and are willing to work with us to make sure we get the best possible outcome, which ultimately benefits them too. So, not just trusting the property managers, being on site, watching everything with a fine tooth comb. And then I think the third thing, man, and this is just something I've seen, it's just, when you work hard and you spend a lot of time underwriting a deal, you've flown in, you've toured it, you've toured the rent comps, you spent probably 100 hours and you get that LOI out, and a high flyer comes in behind you. They make the mistake of compromising their underwriting to win the deal. And that's challenging because it's tempting, right? Oh, can we bump it up 100? Can we just tweak this rent growth projection just a little bit to make the deal work? But thankfully we have a 5-person investor committee, and our asset manager, our acquisitions person, myself, Mark, and our director of finance. It has to get past all 5 of us. And I don't mind sharing, Madison, our director of finance, is very skeptical. And so she's the one who goes, guys, calm it down. I know we need a deal, but this isn't the right deal for us, right? And so just having those open conversations in a trusting environment where anybody can, in a sense, veto a deal has been very helpful for us because, in a challenging market, right, you can start chasing a deal and maybe getting a little ahead of your skis a little bit. So just being very disciplined with your underwriting and knowing when to, hold them and when to fold them, so to speak.
Yeah, you truly make your money on the buy. It
Yeah.
doesn't matter what you do; you'd be chasing it all the way through, and you finally get to refinance, and you might need to bring cash to the table to refinance or
Yeah.
sell.
Yeah, that's right.
I haven't had that problem because my underwriting is very conservative, but a lot of groups got themselves in trouble just because of that to win the deal and then find out in the end. So
That's right.
and then showing up unannounced property manager. These property management companies, third party, they hire people to put in front of them. So you're hiring the company, but they're hiring the people. And
Right.
every problem, in my opinion, stemmed from somebody just lack of caring, just
That's
like picking up the trash. If you
100%.
care enough, you'd bend over, pick it up, and it's pride of property. And perception's everything when you pull up to their property, starting from the front door as you get in. You expect what you're going to go into when you pull up and see the property. So
That's right.
but very cool.
And I think for Mark and I, having come from residential real estate, there's sort of the idea of staging a home to sell, right? And so we work with the designer on all of our properties. So we fly the designer in. I mean, throughout the process, they're helping make selections virtually, right? We send photos, videos, floor plans, et cetera. But when it comes time to install, she'll actually come into town and spend the day and just do those little finishing touches. And, just to your exact point, right, that curb appeal, it's no different than when somebody's buying a home. It's that same emotional process. Like when they pull in, what does it feel like? Am I greeted? Does the property manager stand up and greet me at the front door? Or do I have to walk around this leasing office and poke my head indoors looking for them, right? So part of our process with our property managers is we have a curated walk tour all the way down to a whiteboard when they walk in. It says, welcome home, Susan, whoever the prospect is. And, little things, making sure our refrigerators are stocked with not just those cheap little 4-ounce bottles of water, but LaCroix and little snacks for the kids. We call it the love fridge. And, just all those little things that cost a very small amount of money total up and equal a very big thing. So that impression, right? So 100% agree. That first impression is so important.
Yep. Good stuff. What would be some paths you would recommend someone going down if they're looking to get into multifamily real estate, whether they're wanting to invest or if they're wanting to come in as an operator?
Yeah. So for those looking to invest, I think that being thoughtful and really doing the research into the operator themselves, right? And I'll say it, right? We're a newer group, so our track record of success in other businesses and in the pedigree of the team we brought in, right? So, just really asking a lot of questions. It's not so much about the deal, and you're right, it all starts at the buy. And, I would say an okay operator, if they buy the right property, can probably produce a pretty good outcome, right? But the difference between good and great, I think, does come down to the operations and the team behind it, right? And so not just getting sort of mesmerized by the deal itself, really slowing down and interviewing the operator and making sure that they share your values when it comes to, the service that they're, saying they're going to provide, questioning the underwriting assumptions, right? And really digging in deep there. So that would be number one advice there. I've made the mistake in my past, right? A friend brings me an opportunity and it looks good and I don't spend enough time researching. And thankfully, I've never had an investment go completely sideways, but I've definitely had some that didn't produce the outcomes that I was hoping for, right? So doing a lot of research and due diligence into the operator themselves and their track record of success, whether in this business or another business, right? From an operator standpoint, we had the benefit, as I mentioned, of having other prior successful businesses. And so we were able to fund it. But I think for me, if I were, advising, say, a younger person that was looking to get into this business, I would encourage them to go work for a business that does this thing, right? And really learn, because it doesn't take a lot, in my opinion, to make a massive mistake that could just rob your investors of all their capital. And because initially a lot of our investors were friends and family, right? And that has kind of shifted now. But, and I'm putting my own personal capital alongside Mark into these deals. It's the idea that I might lose a friend's money, would make me like throw up, right? Like it makes me very nauseous. And so that level of care and focus. So, I do think that, and I'll back up a little bit, but, you look at like 2018, 19, right? And there was all this content online and you can find books like how easy it is to do this business. And now we're seeing the results of that today, I think, where you're seeing operators in trouble. And without being ugly, you just kind of look at the deal and you look at how it was bought and the kind of debt they got. And you're like, no wonder this deal's troubled, right? So on our side, we applied a rule. We will only do fixed rate debt. Like we just will not do floating rate debt under any circumstances. So if the deal doesn't pencil with fixed rate debt, we just don't do it. And that's applying a lesson that we've seen the pain caused by operators that did that in the peak of the market, right? So yeah, that would be my advice. Like go work for one of these companies, right? And really ensure you understand the ins and outs and the mechanics of it. And if that's not an option, start very small, buy a 4-plex or an 8-plex, right? And operate that for a couple of years. And if it goes well and you exit that deal, then so I guess to say, a mentor of mine, Gary Keller, who started Keller Williams, said, go small to go big, right? Start small, start slow, build out your systems and process, ensure that you can produce a successful outcome and then go up. Like maybe don't start with a 100-unit deal or 60-unit deal, right? Start small, build up your muscles and exercise those muscles. And then once you feel confident and strong, then you can kind of maybe up in size a little bit.
Yeah,
but it goes
one thing.
Yeah, what's that?
The one thing. Read the book, The One Thing.
Right. Exactly right.
Very cool. That's good. Good insights. Definitely. I like to start small for sure. If you can start small, house hack even, become your own little operator, and then just start from there because nothing can replace firsthand experience.
That's right.
Just getting out there, getting the transaction experience, getting the hands-on experience, and dealing with the toilets, termites, and trash.
That's right.
And then passing it on. So very cool, John. Definitely appreciate your time today. Yeah. If the listeners want to get a hold of you, learn more about yourself, learn more about the company, how can they reach out?
So Faris Capital Partners, that's FARIS, capitalpartners.com. Or you can find me on LinkedIn. I'm not big on social, but I'm on LinkedIn, so you can find me on there. Thankfully, my name, there's not too many of us running around out there. So if you type that into LinkedIn, you'll find me right away. But happy to connect, and but those would be the best ways.
Awesome. John, definitely appreciate your time. Look forward to following you and the company, and we'll talk soon. Thank you.
Awesome, Josh. Thank you so much. It was fun.